welcome to our premiere episode of Thought Crimes Podcast, the podcast where no topics are off limits. If you or I or Jason here were able to learn even one thing today, I think we've accomplished our mission. So Jason, introduce yourself real quick.
Well, thanks, my friend. My name is Jason, and I'll be the co-host of the Thought Crimes Podcast. And Willie and me have been friends for the better part of 25 years now. I've known each other our entire lives. And we have many interests, and there's a lot we want to talk to you about through the course of this podcast. We'll be covering finance, economics, politics, ideologies, fashion, you name it. We don't pretend to be experts in all things. We have general interest and a bit of knowledge here and there that we're happy to share. And hopefully we'll learn as we go, and so will you. And we hope you enjoy the ride.
Nailed it. Right on. Yeah. We hope you guys keep listening to us. You can find us on locals.com, Apple Podcasts, Spotify. And if you guys have any questions, requests for episodes or topics we should be delving into, let us know. We'll be happy to do an episode on that. So today we figured we'd start with a very hot topic, especially on the internet. And the topic actually was born from the internet. And that, you might have guessed it, is the GameStop situation, sorry. So GameStop, Jason. Jason, I think, can give us a pretty good summary of what has happened. He's kind of not only my best friend, but my go-to finance guy. Maybe not qualified to give advice on the podcast, but gives me some advice sometimes. I consider myself somewhat financially literate. You know, I invest, I dabble. But this guy knows all the terms. He knows how it works. And yeah, whenever I have questions or need answers, I ask this guy. So, Jason, could you summarize what has happened last week with GameStop, the store and the stock, I guess?
I appreciate the little introduction, but if this was a karate class, I would say I have an orange belt. I could probably beat up 5-year-olds, but other than that, I'm a little bit dicey here.
Well, you can beat up this guy. So
fair enough. All right. So everyone's heard the story, so I'm not going to spend a whole lot of time. GameStop is a company that sells video games. It's been doing poorly, especially through COVID times. Wall Street saw it as a company that's circling the drain. And as a way to profit on this, they decided to open a short position, a very substantial short position. This was uncovered by the Redditors on the Wall Street Bets page, and they decided, out of frustration, out of wanting to make a statement, out of whatever it may be, to stick it to the man. So they all opened the opposing position to a short position, a long position. And what that did is force the hand of the Wall Street guys to cover their short position.
So for those who don't know what a short is, I am familiar with a short, but there was a time where I was not. So what's the difference between, say, a short and simply buying into a company? So buying shares from a company itself.
Sure. So there's a bit of jargon there. I mean, finances is kind of its language in and of itself. A long position is when you think a company is going to continue to do well and the share price is going to increase. So let's say I'm long on Apple. I'm going to buy shares of Apple and I'm going to hold them most likely. I'm going to hold a long position because I think the company is going to appreciate in value. My shares are going to go up and hopefully we get some dividends out of it. The short is the complete opposite. It's a financial tool that you can use to make money when a company is doing poorly, when you think it's on a downtrend. So what the mechanics of a short is that, let's say that I'm the investor and William, you're the brokerage house. And I think shares of, we'll use GameStop as the example. I think GameStop is going down. Let's say it's currently trading at $5 per share, and I think it's going to go down to $2. Well, I don't own any shares of GameStop, and I don't want to own any because I think it's going down. So I say, William, brokerage house William, how about this? I have a deal for you. I want to short the stock. So you're going to loan to me 100 shares of GameStop, and I'm going to immediately sell them. So I'm going to be short those 100 shares because I'm taking shares from you that I never owned and immediately selling them. So I'm selling something that I don't have. So if let's say the GameStop's trading at $5 a share, all of a sudden I have $500 in my trading account, but I am lacking the 100 shares that I borrowed from you. Now, if GameStop goes down to $2 like I expect, great. I'm going to buy back those 100 shares. But buying back those 100 shares only cost me $200.
Right.
So I buy that, I pay the $200, give you back your 100 shares, and I'm left with $300. So a successful short.
Right.
The problem with a short is that if it was at $5, the most money I could make is between $5 and $0. So the most I could make there would be 500. The problem is that if the company turns around for whatever reason,
Right.
say a bunch of people decide to buy the stock all of a sudden, and the share price goes up to $200, well, now I lost $195 per share that I own.
Yeah.
And you, being the brokerage, is going to say, Jason, I want my shares back. And you're going to call me on it. That's a margin call. So you're going to force my hand either to pony up the cash, so to put that difference, that 19,500 now that I'm in the hole for, you're either going to say, Jason, you need to put that money in your trading account, or I'm liquidating your positions and I'm calling you on it.
Right.
That's what happens.
That's dangerous.
It's exceedingly dangerous. It's a very, very risky play. And when you think what a short does, and when you and me were talking about this yesterday, one thing that you brought up, you're like, I don't see the use of a short.
Right.
I don't see how it generates value in society. I agree. I really don't see the point of it. And as I was reflecting on that this morning, one thing that I thought was, okay, let's say I'm a company in trouble. Well, how do I raise money? I'm most likely already am leveraged. I've probably already gone and seen my banks and my lenders and all that sort of stuff. One of the only things I can do to raise more capital is issue new shares and hope people buy them. My existing shares that are floating around in the ecosphere, I've already sold them out into the market, so I can't get money from them. But if I put out new shares and people buy them, okay, I'll have that capital to use. But if I'm getting just hammered and hammered and hammered by people short selling me, well, if my share was, or my share price would have been at $5 and it's just pummeled down to 2, now the money that I get from issuing new shares is far less than if people wouldn't have been hammering my stock with shorts. So it makes it even harder for a company to get out of the hole.
Yeah, that's what I find with shorts is, especially nowadays with even more access to influence, power, communication with the internet and big media, is that you have guys on Wall Street or from hedge funds who will basically target a few of these stocks, right? And go like, this stock or this chain of stores is going to fail and we know it. But on top of that, we're actually going to kind of influence the market and tell people that it's going to fail, which probably means it'll scare a lot of folks the last few folks who maybe have had stocks in that chain store, that company, which will make their short come true. And that's why this whole GameStop move was kind of brilliant. When you have almost like a little populist movement from the internet, from a Reddit group, some guys poor, some guys rich, I'm sure, who decided, hey, no, enough of this this short game. We're going to play around with this stock and we'll make it worth like an infinite amount compared to that short. So that's what I find. Not only do I fail to see a use in a short, is that like, use in terms of like, how is it constructive or positive for society? Bet your money away all you want. That's fine. But it's not only just betting your money, it's betting it with the chance that it's times infinity, right? That's what's insane is you could bet. And especially when you've got hedge funds putting, millions and $billion bets on shorts. And then what happens, instead of this stock being $2 tomorrow, it's $500 like we saw, which means they owe billions upon billions of dollars for one simple investment they made. Right. And that's what I find absolutely insane.
Yeah, no, and I agree. And you see the gears of the machine turning to help protect the hedge funds
Yeah. Yeah.
when
Let's
the
get into
US
that a little bit.
Congress, right. So one thing that we see here is that the Robinhood apps, and again, this is part of the overarching story, that the Robinhood trading app has been pretty much the central hub where a lot of the Redditors have been using to trade. One of the functionalities of Robinhood is that you can buy fractions of shares. Most trading accounts, if you want to buy a share of a company, you have to buy it at the full price. So if Apple is trading at 125 US per share and you only have $100, well, too bad, you can't buy a share of Apple. You're locked out of that market. But with Robinhood, you can buy fractions of it, so you're never fully priced out.
Yeah,
Problem is
it's there
when
to, as Robin Hood says in the name, and it's the history of the character. It's basically, taking from the rich, giving to the poor. Not necessarily in that sense, but it's allowing for the little guy to be able to participate in this huge market or get a chunk of these massive shares that otherwise wouldn't be affordable.
right, and you have the best example of that, a very healthy company. Geez, I haven't checked it in months now, but Berkshire Hathaway.
Right.
Let's see, Berkshire A. Jesus, 344,100
Yeah,
US
it's
dollars per
insane.
share.
Yeah.
So
That's Buffett's company.
that's Buffett's company. So you're paying 344K US for one share of Berkshire, and they don't even pay dividends.
Yeah, that's crazy. I am aware though that they recently made a share where you can buy. It's like, they have class A, class B, depending on certain stocks that are too expensive, and one you can buy for much less. I know that now. I think it's the class B, maybe.
The class B, I think so.
Yeah.
It's been a while since I messed with that company, but yeah, to get back to what we're saying, then Robinhood locked out the buy function for GameStop, but left open the sell function, which helps the short trading position, but not the long trading position, because you can keep on selling, but you can't keep buying. And that's where Reddit went from, okay, we're sticking this to Wall Street out of frustration of whatever, spite, frustration, and we can get into that later. Is it caused by COVID? Is it caused by job loss? Is it the turmoil in the world? Is it the later cycles of an empire showing itself? What's the underlying cause of all this? But the move that GameStop did there, all of a sudden painted a target on their back, and now everyone who was going long on GameStop now has a new enemy in sight, and it's Robinhood.
Yeah, so let's talk about a bit about that. So you have Robinhood, which is what I find ironic in all this. Robinhood is this app that allows the little guy to invest with the big fish, and it's how it's marketed itself. It's a very millennial type of app. It's it's a very benevolent app. All this stuff allows the poor to get richer. Blah blah blah. However, during the last few days, when GameStop started blowing up and everybody realized that the hedge funds that were investing shorts were going to get completely screwed, then you have apps and banks like Robinhood that decide to put a halt on everything and basically tell the little guy, no, you have to stop buying stocks. And if you don't, we're actually just they shut down that stock. You weren't able to buy any shares in GME, in GameStop.
And there is circuit breakers in the stock market, and you'll trip a circuit breaker when there's too much movement too quickly. And
isn't it like
isn't
it like a 5-minute pause or something?
It's a 15-minute pause.
Okay.
When a security, so a share, but the last time I saw this happen more broadly was March of 2020, when the first crash of the stock market happened with COVID, the overall broader index, the S&P 500, dropped by whatever, like 18% in a day or something. But when it hit that 17% or that 7% mark, first circuit breaker. Everything is closed for 15 minutes. No trading is allowed. Everyone calm down for a second here and reevaluate what's going on.
It's basically for everybody to gather their thoughts. And
pretty much just
I guess.
Take a break, breathe. It's going to be okay. Then there's a second circuit breaker, same idea at 13%, another 15 minutes. Now that's dicey. There's a third circuit breaker at 20%, which it halts trading for the entire day. Trading's done, that's it.
Wow.
And like the not the key metric, but like the overall sentiment to know that if you're in a recession is when you fall 20% from your high. So if you fall 20% in a day, something happened. And recently, well, that was the whole COVID scare.
Right. Yeah. Okay. Neat. So, yeah, let's talk a bit about the market itself and market manipulation. So, what I find really funny and again ironic is that you have some folks and some parts of the mainstream media and Wall Street who are upset at the little guy and trying to demean and call names to all the people on the Wall Street bets chat. However, what I find kind of funny is that it's the people on Wall Street that have been doing that for decades and decades and decades. They had their big boy club and they were able to essentially pass the word around for the stock, which stock they wanted to go up or down, depending on what bets essentially they had put on it. And now they're really upset that they got screwed from another movement that does the exact same thing, but to them.
Pretty much. So you have, there's the stock market has a function and investors have a function. And there's obviously regulation. There's a Security and Exchange Commission in the United States. There's commissions all around the world that set the stage, and that's the parameters within you have to operate. Market fixing is illegal. So if I own a hedge fund and you own a hedge fund, you and me are not supposed to communicate on what we're doing because we're both large actors, and it's kind of insider trading in a sense.
Right. Insider baseball, let's say.
Yeah, exactly. But people are creative, people are ingenious, and they always find a way to bend the rules. And with the markets, it's somewhat simple. You don't have to go very far to bend the rules because there's so many tools with which that you can use. And when you're controlling such large swaths of capital, you can move the tide not significantly, but enough to make your positions work. So when you start looking at options and swaps and calls and puts and all these other instruments that are available, what you're essentially doing is using money to create money, but without really generating any underlying value.
Right.
And I think that's where things start to get a little bit dicey. And you and me spoke a little bit about this yesterday. So what's the purpose of a stock market? What's the purpose of a hedge fund? And we really dialed it back a little bit. And all a stock market is really supposed to do is just define fair value of a company. And it's also there for a company to offer shares to raise capital so that people can buy into it, have a certain voting right onto a company if they're holding common shares, hopefully get capital appreciation, hopefully get dividends, and be along for the ride. So it's a win-win. The company gets those dollars that they need to scale up, and people get voting rights and possibly cash flow. That's healthy. So
I actually see constructive use in that, right? When anybody from a hedge fund to the average citizen can invest in a company. Well, first of all, they're helping that company maybe because they believe in that company. They like the product, they use the product, whatever it may be. It also gives them more capital so they can invest in a new technology, or they can give some of their profit back to their own people who've invested in that company. So I see something constructive with the stock market in that sense. That's where I have a more of an issue with shorts, where I'm like, what the hell? What's the purpose of a short?
All shorts really do is give you a tool to make money when the market's going down.
Yeah,
that's all it does.
Yeah.
So if
and often praying and wishing that the company fails faster.
Exactly. So you're creating a downward spiral there. And then you have to look, how do hedge funds make money? Well, they get paid on assets under management. So if we both, you and I, each own separate hedge funds, and I have $10 million of assets under management, meaning people have given me a total of $10 million to control and to invest, and your hedge fund has 50 million, well, my commissions that I pull from that 10 million and your commissions that you pull on that 50 million are how we get paid. So I'm incentivized to catch up to you using whatever means it may be. All my customers know is that they gave me dollars and I made dollars. 9 times out of 10, 99 times out of 100, that's all your customers can be worried about. Is my portfolio going up? What you do with it is up to you. Now, there's obviously the know your client and all that, and they have certain risk tolerance. You have to operate within certain frameworks. But that's kind of the competition between hedge funds, and that's where you start to see the incentive to do shady things, like exactly what we're seeing with HedgeStop, where the position of the short was greater than the available shares.
Yeah, that's short. Nuts. Yeah.
I think when I looked at it a few days ago, the short position was 121% of all the available shares. So that means more shares were in a short position than were able to be shorted.
Yeah.
And I think that got up to 140.
Yeah, that's what I heard too. At some point it was 140%, which is insane. If you simplify for some folks, I think about it like, if I have an apple tree in my backyard, and I know every year that apple tree makes roughly 100 apples, but I live in a village where there's 140 people, and I promise all 140 people that they won't starve because they're going to get an apple. But I know that deep down, that apple tree only makes 100 apples. So when summer comes and I've got all my apples, I give it to the first 100 people, and then the last 40, I'm like, oh shit, out of luck. Sorry. Even though I promised you this.
And that's assuming the underlying asset, the apple tree, produces it at its full capacity.
Exactly. That's best case scenario is what I'm talking about.
Yeah. Exactly. So that's kind of one of the things where you look at a hedge fund. Well, how are they incentivized? They're incentivized to attract more clients to their hedge fund to make more commission. And just let's say I'm a client and I'm looking at 2 hedge funds. Which one am I going to pick? And one hedge fund says I made 30% last year on for clients that have a similar portfolio to you, and another hedge fund says I made 5%. Well, I'm going with the guy who made 30% because 30 is more than 5. Right? It's simple.
Yeah.
But at the same time, maybe that the hedge fund who made 5 was sticking to traditional tools, and the one who made 30 was playing a little bit more in the gray.
Risky,
what's going to happen is you're going to push out the ones who work ethically, let's say, if we want to oversimplify, and the ones that are willing to go a little bit more in the gray zones and do things like what we saw with GameStop, which is not illegal, just a little bit odd, to say the least. Well, those are the ones who are going to be incentivized to keep doing what they're doing, because they're the ones that are going to generate the greater returns, therefore attract more people and more assets under management.
Right. So what I find, or I think what everybody's finding juicy about this, is that for one of the first times Wall Street and the hedge funds have been kind of put back in their place, or scared by the little guy. And you just kind of see at what point they're too big to fail, which is a horrible system, right? It's kind of like, well, even if we made the most irresponsible bets and gambles on our own and other people's livelihoods, kind of like the 2008 crisis, we're too big to fail, so that if we mess up, well, we'll be backed up by the Fed. The government will come in and bail us out, because if we do fail, if no one comes to help us, then everybody loses, right? Which also I think is part of the FU that the Reddit guys decided to plan against these hedge funds.
Absolutely. Like, what does too big to fail mean? Too big, just like
Which
you
is a
say,
dangerous concept, right?
there.
To an extent, especially if you're being irresponsible and bet that money.
It's about as antithetical to a free market as you can be.
Right.
As a free market says, you need creative destruction, you need things to do well, you need things to do poorly, so that the best things can last and be. When you're too big to fail, like what you're saying with hedge funds, well, let's say that a fund, maybe not a hedge fund, because usually a hedge fund is only for accredited investors, which are people that are making $200,000 per year or have a net worth of over 1 million, if I'm not mistaken, in Canada. Usually it's riskier investments. So it's people that are already better off to begin with, who have access to hedge
So
funds
guys like
generally.
us, right?
Yeah, guys like us. So maybe if we cloned ourselves and did the little dance in Dragon Ball Z and infused and took on Majin Buu, then maybe we would have that.
Yeah.
But anyways, like a good example of that is pensions. Well, let's say I'm managing pensions and I want to put that partially into a hedge fund, because with all the assets that I have under management as a pension manager, I have the capital to allocate some of that into a hedge fund, maybe 20% of the total portfolio. Well, if the hedge fund fails, that means the pensions are falling very, very steeply, and that's affecting everyone who's drawing a pension. So now that's where the too big to fail comes in, because
Right.
oh, okay, you want to mess with our hedge fund? Well, grandma's not getting paid next month.
Yeah.
That's where it comes in.
Yeah, that's where it gets really messed up and scary. Now, if we turn the page a little bit, we look at this populist movement, this beautiful thing that happened thanks to a chat on the internet. Let's talk a little bit about what you think the future is, and maybe talk about some other types of hype. I know like crypto is huge. Everybody's trying to invest in that. You saw around the same days, crypto kind of skyrocketed. Bitcoin did well. We have kind of another meme one that did very well called Dogecoin. So let's talk a bit about that.
Okay. Well, again, not financial advice, but don't buy Doge. It's a meme. Like if you're going to buy a cryptocurrency, get a cryptocurrency that does a thing. Doge is just Doge to be Doge, and that's it. It's funny, it's entertaining, but it has no underlying value. So just don't buy Doge unless it's pure gambling.
Yeah, it is pure gambling. I guess it's just to see if if Doge goes up while you own it, I guess the only thing you can do is trade it for Bitcoin or something like that.
That would be about the only thing. You see a lot of that with altcoins, where what you're aiming to do is either you're holding cryptocurrency for its function, or you're holding cryptocurrency for its value relative to fiat currency. And fiat currency is like Canadian dollar, US dollar, euro, just dollars that have been made but really don't have anything backing them up, which is all of the currencies in the world, pretty much. And we can touch that later too. So let's say I own 1 Bitcoin and I'm super risky, and I'm going to take half of my Bitcoin and put it into Dogecoin. And then all of a sudden, Doge went from 1 penny to 4 pennies of the US dollar if we tack it to the US dollars. So I quadrupled my amount or my value of Dogecoin. I sell it back into Bitcoin. Well, that half Bitcoin that I put into Dogecoin is now worth 2 Bitcoins. So now I have 2.5 Bitcoins. So that's one way that people use altcoins, is they think the altcoin is going to outpace Bitcoin. So that way there it creates a larger return, sell it back into Bitcoin. You have more Bitcoin than you started.
Yeah, it's another type of currency trading with fake currency in a way.
Yeah, it's basically like trading for, I guess you could say it's kind of like Forex, where you're doing one currency versus another currency, trying to make more currency out of currency.
Yeah, exactly. So yeah, I'm just curious. I guess we're seeing more and more internet powered movements or hype movements that relate to currencies, investments. It's interesting times we live in.
So you being a student of history, me being curious in world events and what's happening right now, You and I have both spent a lot of time reading and writing and watching. And one of the podcasts is on the fate of empire, and it's going to tie into to this quite a bit. But one of the things that Sir John Glubb there talks about is that you have to understand the cycles of civilization to be able to somewhat predict the future.
Right. To truly
And
understand history. Yeah. You need to
so
look
what
at
I'm
it from a more holistic approach.
and I think what's happening here is it's more than just, a little bit of pent up frustration. It's more than just people trying to stick a middle finger to the man. If we just look at the economic side of things, there's been no real wage growth since the mid 1970s. So we've seen essentially stagflation, which is where the
Mm.
cost of goods and services keep going up, but there's no actual real economic growth. So there's no counterbalance, and that translates to depressed wages. So you got 40 years of things getting more expensive and really no extra dollars going into the pockets of the common man or woman. You add on top of that increased censorship, increased control at an alarming rate more recently. You add on top of that the 2008 financial crash that really hurt a lot of the older millennials who are just starting to come into the labor market, who are often overeducated but underemployed and underskilled.
Yeah.
Then you add on top of that the corona crisis, where you can't go to work in a lot of cases. Your dollars are becoming increasingly worthless. You're seeing political turmoil. You have the government in the span of a year, whether for good or for ill, all of a sudden you went from live your life to now you have to wear certain clothing in public. You can only associate with a certain amount of people. Uh, Essentially, all you can do is go to work if you're fortunate enough to go to work, and then go home.
If the government
And
allows you to go to work.
exactly. And if you're a small business, well, screw you.
Yeah.
So you're seeing a lot of pent up frustration, and you're seeing a lot of the symptoms of a society in decline, without getting too deep into that. And I think the things like the Wall Street bets is just a symptom of a larger problem. And I think we're starting to see a bit of the peasants revolt
Mm-hmm.
against the elites. And I think things are going to get worse before they get better. But eventually, I only see this going to more chaotic times, let's say.
Yeah, I think we both agree there that it will get worse before it gets better. But not to create a huge tangent here, but what I often find a lot of people like to say, especially the mainstream media, it's kind of like they like to right away quash anything that resembles populism, right? To which my argument would always be a certain amount of populism in any nation or state is healthy. I think it's necessary. I think everybody needs somewhat of an identity, somewhat of a common goal. They need to feel somewhat nationalistic about where they live and what they're going to build for their kids, et cetera, et cetera. So it's always neat to see populist movements arise. And now what's interesting is that you have these entire internet and social media tools that are creating new outlets and new ways for populist movements to not only grow, but create different problems and solutions, right? Like this whole Wall Street story. So I think a healthy amount of populism is always good, and that's what it's gonna be interesting to see how the next few years and decades play out.
Uh, I think you're right, and well, I'll let you keep on with the thing. I had a thought, but she went away.
All right, all good. But the another you mentioned kind of like we're in an era of decline, to which I don't disagree much with you there. But another thing I think, especially this movement that happened with the Reddit guys, is I think a lot of people are still very pissed off from 2008 as well. I think
And I
they're
mean,
not only is it like a general all of these things you mentioned, which I think all have merit and are all valid, but I think 2008 really pissed a lot of people off because it also ruined a lot of average Joe's lives, a lot of families' lives that were not implicated in any way in gambling millions and billions on Wall Street. And then seeing that the government was like, well, they're too big to fail. So as usual, we're just going to help those guys out. They keep their bonuses because their losses were matched. And then the little guy loses his house.
Right. So obviously 2008 was a good time ago. It was, 12 years ago, 13, going on 13 this year. But people still remember, to your point, what happened. And the underlying point here is that people were just going about their lives and all of a sudden their savings were gone. Well, I went to work yesterday and I went to work today. I didn't do anything different. So why is everything crashing around me? I didn't do anything. And people still hold a large amount of resent to that. And what happened since then is we had before that, but just the continuation of it is we had modern monetary theory, where what governments are saying is money printer go burr, we make more dollars, problem solved. Problem is that every single society in decline has tried that. The Romans have tried it. The Weimar Republic in Germany has tried it. One of the most recent examples is Venezuela, which is an ongoing example. Oh,
Zimbabwe as well.
Zimbabwe, they had $1 trillion notes.
Yeah.
And that's what happens. At some point, people lose confidence in the currency and then revert back to something that has value, usually gold or whatever. But not to put the cart in front of the horse here. So 2008 happened. There was the bailouts. People lost jobs. People lost their savings. It was bad. We all remember that. What happened since 2008? Well, the stock market between 2008 and right before the coronavirus, all it did was go up. Like, sure, there was little dips. I think 2013, there was a little bit of a downtrend, but it quickly recovered and went up. What permitted this to happen? Ever lower interest rates and money printing. And I even hesitate to call it money printing because it's not actual money, because it's not a store of value. It's currency printing. It's fiat currency.
And at this point, isn't it basically just number crunching?
Pretty well. It's just an Excel spreadsheet and boom, here are more dollars.
Yeah.
So the government will go to the treasury that's the Bank of Canada, the Federal Reserve. They just type dollars and send it back to the government and say, okay, eventually you're going to have to pay us back with interest. Yeah. So currency is created, and then you have the Cantillon effect, where wherever the dollars go first, they have the most effect. And usually what we've seen, especially since COVID, is that the first place the dollars have gone is back into the stock market. Yep. So all we've done since the COVID stock market crash is just reinflate the stock market with new dollars that have to be repaid.
Yeah, and you want to talk about the perfect talking point of making the rich richer and the poor poorer. That's how you do it. Because the whole point of the Cantillon effect is by the time the money trickles down to the little guy, the money is worth less, right? The buying power is lesser than when it was initially at the hedge fund level or at the stock market level.
Exactly, because as it goes through, well, you're going to create supply shortages. So there's going to be price increases because you have to increase production and things are expensive to create on the fly. And then how long, you and I both have, modest stock portfolios. I've seen nice gains since the beginning of the corona. Yeah. And I didn't do anything different. I'm no smarter than I was. All I did is, here's money, RRSP, buy me shares of the companies that I like. But why is my purchasing power increasing versus if I would have not done that? So, and I'm a pleb compared to these hedge funds and these rich people. Say, and just arbitrary figure, say I have $1,000 in a broad market in an ETF that covers the entire S&P 500. Well, okay, good. And I don't know, let's say it went up 20% since that crash. Great. My $1,000 is now worth 1,200. Mm-hmm. If I had 10 million, now it's worth 12 million. If I had $1 billion, it's worth 1.2 billion.
Yeah.
So you're seeing the exacerbation between people who have and people who have not. And that's without having your business be shut and being forced to stay home and having no recourse.
So basically,
no wonder people are mad.
Yeah. So basically there's going to be a balloon that bursts soon. That's what it's setting up to.
Right now, we're in the everything bubble. So
Yeah.
2008 was the housing market bubble, where they were giving loans to buy property to anybody and everybody, regardless of uh, of, of quality. So whether they had the capacity to repay or not, they bunched all these people into a bag and called it diversified. Just it was a diversified bag of turds, essentially. Now, what they did since 2008 is they kept lowering interest rates, except I remember this. There was a time in 2018, between September 2018 and December 2018. And you and me, we would have been 28 at the time. I remember at Christmas time, you and me went and we snowshoed around Pritchard's Lake. And we were still kind of learning, like we both started investing a little bit, but we definitely didn't have the knowledge that we have now. And we were talking about, I think, about the big Canadian banks like RBC and TD. And we're both looking at it, we're like, why are things crashing? Why did TD go down all of a sudden? And we're both like, do we buy now? Like, is it like, do we stay away?
Right.
Like complete
Yeah. My
confusion.
Scotia wasn't doing well. I remember.
Exactly. And we're both like, do we buy this dip? Is it a dip? We really didn't know what was happening. But what's happening is that the monetary policy went from quantitative easing, which is lowering interest rates and increasing money supply, modern monetary theory, to they just try to tighten it a little bit and try to retire some of that currency that had been used to reflate the bubble since 2008.
Right.
So 10 years later, they tried to tighten it just a hair. And they brought up, I think, the base interest rate in Canada from 1% to, I may be mistaken here, but I think maybe 2.25%. What did the stock market do? It tanked. Because in December of 2018, you just saw like a 5 or 7 or whatever percent drop. It was just pretty well in the span of a week and a half. But what did that signal to the policymakers? It signaled that we are so over leveraged, that we've borrowed so much money that even if you increase our interest rate by 1%, we will fail. So what's our base interest rate now? 0.25%.
Yeah.
There is nowheres to go. And on top of that, we've printed, money printer went burr. We've printed the infinite amount of currency that we did, but it's debt. It's debt that
it's attached to no value.
People understand that borrowing money is debt, but they don't understand to what point it's damaging. Because there becomes a point where your debt service, the amount of interest that you're paying, becomes more than you're able to generate. That's when you look at debt to GDP. So we have so much debt and we have so much gross domestic product. Well, at what point does the gross domestic product not even pay the interest on the debt?
Right.
So what's the answer? Well, okay, no problem. We'll just lower the interest rate.
Yeah. Which is the same thing that's happening. Sorry?
Well, where do you want to lower it to? We're at 0.25%.
Yeah. It's the same thing with slightly higher, but not much higher, the housing interest rates, right? It's the same kind of thing on a smaller scale, still massive scale, but house prices, especially in urban areas, are skyrocketing. They just aren't stopping, even though COVID has devastated everything, because the interest rates are so low that almost everybody can afford a house now, right? Or they can afford to make a down payment on a house, because the money's that you can have like a 35-year mortgage now, and the interest rate's a joke. So yeah,
exactly. And if you are to do that, get a fixed mortgage, even if it's
exactly.
0.5% more. Get that 35-year mortgage, lock it in for the 35 years. If it's a variable, and again, not financial advice, but just think about it for a second. If you have a variable mortgage rate that's at 2%, but it can change every 5 years or whatever, well, what happens if things crash and now all of a sudden we have an 8% interest rate? Can you float that? If so, okay. If not, you're in trouble.
Yeah. So let's take it home here with because we're setting up a first doom and gloom episode, but I mean it's kind of true. But what's next here? I guess we can't give financial advice, but kind of how do you see the future going here, and what should be our recommendations for our viewers too of what to invest in, and not necessarily monetarily?
Well, we have a fractured culture. We have a broken monetary system. We have an increasingly angry population, and we
And
have
divided.
and divided. And we
Yeah.
have basically external threats like China that are making deals with our leaders and steadily growing their influence on our shores. Well, I don't think we have a whole lot of good coming our way. I think our generation, I think we're going to have a tough go. But what's the immediate next? More likely than not, I would say you're going to see a stock market crash, but not a crash to the downside. I think you're going to see a crash to the upside, because where else are people going to put their dollars? And what is happening? The solution from the central planners is just money printer go burr, and then it just inflates asset prices. Well, there, if you buy bonds, the 10-year yield is something like 1% right now. So if you think, oh, I'll buy bonds, it's safe, and then in 10 years I'll have my profits. Well, you make 1% per year. Inflation is targeted at 2% per year.
Yeah,
So you're
bonds are
losing
useless.
so you're losing purchasing power. Your savings account, well, your savings account is tied to the base interest rate, so you're making 0.5% at best. So even worse. Um, a lot of people are priced out of the housing market. Never mind the rental property market, which is even more expensive. Um, so where do people turn to hopefully have increased purchasing power? You have the stock market, but that's not what the stock market is for. It's not supposed to be the place where you put your dollars and then magically you're rich. It's supposed to be a place where companies generate capital and people make wise investments. But especially now with pensions and RSPs and all these passive investments, well, that's where your dollars are going no matter what. All the pension managers have to put it somewhere. More likely, more times than not, it's going into the stock market. So I think you're going to see a crack up. I think you're going to see the stock market take off like crazy, price a whole bunch of people out, and then where are people going to go from there? There's going to be nothing left.
Yeah, so there's going to be even more of a divide, I guess. I guess a two-tier society.
At that point, I don't know what the numbers are, but I think when it gets over a certain threshold, that's when the peasantry uprises, for lack of better terms. And I'm not saying like that's the only thing that's going to happen, but that's, if we're just talking economics and stock market, I think that's what you're going to see first, and it's going to be one of the many symptoms of maybe a revolt, maybe not, but at least a very discontented society.
So let's close it off here with switching away from monetary investment, from the stock market. How do you see the future, and what should people be I don't know, investing, putting their time and money into? I have a few I guess recommendations, but go for it.
Sure. No, you go first if you got a couple on top of mind.
Well, first one, and you and I often talk about this, is learn to work with your hands, whether that's any type of trade. I think, we talk about how Canada and the US and the West oftentimes has become, other than a few specialized things, we've become a very service oriented industry, which again, when shit hits the fan, a service industry is not worth nearly as much as what a more of a manufacturing base or a raw resources industry is worth, right? So,
which is crazy because we're one of the most natural resource rich countries in the world.
Not to say we don't have a natural resource industry, but Canada has become insanely service based. So to learn to work with your hands is got to be one of the best investments, especially in good times. First of all, in good times, save you money on all sorts of it could be for whatever it may be, plumbing, electrical, woodworking, whatever it may be, machinery. But
automotive repair.
If auto repair, if shit hits the fan, then being able to do something well with your hands is worth a lot for yourself, your family, and your community.
Well, you're useful, you provide value, and you have, in the worst case scenario, something to barter with.
Right. Yeah.
It goes back to the old adage, right? Plan for the worst, hope for the best.
Yeah. And human beings have always gone back to bartering, which is kind of neat. I remember even just hearing the stories as a kid, bartering, it still happens a little bit in our society, not much, but, I remember we're from a small town, and I knew plenty of businesses that instead of buying each other's products or services, they would just swap each other's products or services, right? You get your family, they all get a suit this year, but in exchange, they get free dental care, right?
Mm-hmm.
They get a free checkup this year. So that kind of stuff, I think, if you can offer a tangible product or service or labor with your hands, I think in good times and in bad, that is always worth something.
I think that's an ideal place to start. Land. We saw that in the past few weeks, it came to light that Bill Gates is now one of the largest private farmland owners in the United States.
I think he is the largest now. I think I saw it. He owns the most farmland in the States.
So he's a private citizen. He can do what he wants. And, if he has the dollars to do it, power to him. But what is that suggesting? If he's doing that, and he's probably a lot smarter than you and I, he most likely sees either an opportunity or a problem coming, and he either wants to create a moat between himself and the problem, or wants to set himself up to capitalize on that opportunity. Either way, it signals a large change. And I think the idea of having land is one of the better things that you can do. You combine that with the idea of having manual skills. It could even be gardening, could be growing. It could be just removing yourself away from the city. But what you're doing is you're giving yourself a chance to be self-sustainable. And obviously that can't happen for everyone, and not everyone has the means to make that happen. But for the person living in a high-rise apartment, at the worst, it could be, have 6 months worth of dry goods and canned goods in your apartment. Right. Something like that.
But Jason, aren't you just a doomsdayer now?
Do you blame me?
No. I find that, again, there's always a just middle, but I find that silly. I'm like, I think it's pretty smart for anybody to have like a certain amount of food they can save up first for like, I don't know, if all hell breaks loose and it's winter and it's cold for 3 months, I think it's good that you have some non-perishable food and maybe some stuff to burn.
So what are some things you can invest in? Well, the one thing that always comes back is gold, is precious metals, silver and gold. That's another market that is horribly suppressed. JP Morgan just paid a $900 million fine the other day, like I think last month, for being proven that they rigged the silver market, and everyone knows that JPM rigs the silver market.
That's why there was a bunch of money. They kind of try to do the same thing the other day with silver stocks, right? Exactly.
So silver stocks, SLV, is an ETF, an exchange traded fund that tracks the price of silver. It fluctuates less than the actual price, but still fluctuates. So it's the derivative off of silver. It derives from the value of silver. So when you buy shares of SLV, you're buying a claim on silver that supposedly the company is keeping in storage. So if you can't actually own physical silver, it's a way to pin dollars to potentially silver. But you see the problem here, because you don't actually have the silver in a time of crisis. Well, you essentially have a bank run on that silver.
Right.
So currencies usually revert back to their fair value of zero. So, our Canadian dollars are intrinsically worthless because they do nothing and are pegged to nothing. So what is the go-to? Usually precious metals. The problem with precious metals is that probably so few people have some, and so few people would know what to do with it, that it might be hard to exchange in. We're seeing the right, but still very much worth having. I like precious metals, and I think everyone should have at least a base amount of precious metals, just like you should have a base amount of food in your apartment or your house. Cryptocurrency. The whole idea of cryptocurrency is getting around the entire financial system and being able to do contracts between yourself and myself without third-party interference. You combine with that limited supply, which is one of the big things for Bitcoin. you put a stack on top of that blockchain. There's a lot of good things happening there. So that might be an avenue you want to explore. At the end of the day, real estate, even if it's expensive, a house is always worth a house, especially if it's an apartment building that you can rent out to other people. People are always going to need a place to live. It always has intrinsic value. So what I'm getting at is you want to have things that have value by its nature, whether it's skills, knowledge, precious metals, cryptocurrencies, if you want to go down that route, hard assets like housing, preferably housing that you can rent out to other people.
Absolutely. That's shown to be a very lucrative investment in this day and age.
So yeah, that's about what I got. What do you think?
No, that's great. Hopefully everyone here learned a thing or two. I know I did. And our next episode will be, we actually just recorded it before this one, and it's slightly related. We're going to talk about another fairly topical issue, and that's the raising of minimum wage. So we're going to try and talk about the arguments, go through the for and against arguments of minimum wage, having one and raising the minimum wage. So join us next time for that. And I promise not all of them are about fiscal policy and economics, but it's where we start. It's what's making the headlines, and it's kind of great that it's red pilling a lot of people financially. Hopefully, a lot of people who didn't understand a lot.
If we want to end on a happy note, absolutely, to your point.
On a happy note, exactly. Red pilling a lot of people into financial savviness somewhat, and maybe understanding just how slightly rigged the stock market has been, and seeing that there's new avenues for which the population can themselves fight back.
I think that's a happy place to end.
I agree. All right, join us next time, guys. That was our first episode of Thought Crimes. Cheers.
Cheers.